Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I think it was the maverick Jim Cramer who once remarked that there's always a bull market somewhere. Well, if you look at the broader Indian indices, I don't think you can call them a bull market. The Sensex has returned a little under 5% over the last 1 year, not a bull market by any stretch of imagination. But what about returns like 220%, 253%, 106% and even 57% over the last 1 year? Can you call this a bull market? I do think so. These are the returns earned by Titagarh Wagons, RVNL, IRCON, IRCON and RITES, RITES, respectively in the last 1 year. And if their magnitude is anything to go by, there is definitely a bull market underway here. These four stocks have one more thing in common besides their impressive returns. Their fortunes are tied to the fortune of the railway sector in India. Put differently, if the railway industry in India grows at a fast pace, these stocks would be some of the biggest beneficiaries. No wonder they also go by the name of railway stocks. Anyways, this piece is not about whether you should buy railway stocks, especially after their crazy run up in the last 1 year or so. This piece is about the right exit strategy for them. Does it make sense to book profits, or is there still a lot of steam left in these fast-chugging stocks? Now, the conventional wisdom about exit strategies is pretty straightforward. It says that you should sell a stock if it meets one of the following three conditions. These conditions are: your original thesis has changed, you realize you made a mistake, or you found a better opportunity. Now, no doubt these are solid grounds for selling a stock. However, the problem lies in their execution. How do you know whether your original thesis on a stock has changed? Perhaps the change is only temporary in nature and the stock gets back on track in a few months. Also, how do you know whether you made a mistake in analyzing a stock? In fact, there could be a lot of confusion around what even qualifies as a mistake in the first place. Lastly, the point about selling a stock if there is a better opportunity elsewhere is also sound in theory. But when it comes to practice, there are complexities galore. How does one know for sure whether the other stock is a better opportunity or not? Do you judge it based on the business quality or the underlying valuations? Also, should the other stock be twice as better as the one you are considering selling, or only marginally better? I hope you're getting a fair idea on why selling is such a difficult thing to do. And this applies to not only the railway stocks under discussion, but overall as well. You will find hundreds of pieces on the internet about how and when to sell your stocks. Still, it is their practical utility that leaves a lot to be desired. Therefore, if literature around selling is of little use, how about learning the art of selling from the personal experience of stock market gurus out there? And when it comes to gurus, who better than Warren Buffett? Can we look at Warren Buffett's selling history in order to understand his thought process around it? Does the Oracle of Omaha have an exit strategy that he has deployed repeatedly in the past? And I'm sure some of you are wondering that Warren Buffett is the wrong person to learn the art of selling from. After all, one of his favorite words are that his holding period is forever. Put differently, once he buys something, he likes to hold it forever. So what can a person who does not like selling, who loves holding, teach us about how and when to exit a stock? Well, there's a difference between buy and hold and buy and forget. And Warren Buffett is certainly not the buy and forget kind of investor. His holding period may be forever, but he is known to sell a lot of stocks where he felt that the fundamentals had changed for the worse and they no longer deserve to be held forever. Now consider, for example, Tesco, one of his most high-profile investments. Warren Buffett first bought shares in the British supermarket giant back in 2006. But he started selling the stock in 2013 and was out completely by 2014. So is there any lesson that we can learn from Buffett's holding of Tesco for around 7 years and then exiting completely within a span of 1 year? Well, as per Buffett's own admission, he made a big mistake in selling his Tesco shares as the supermarket's problems kept on escalating. According to him, a more attentive investor would have sold Tesco much earlier and would have perhaps prevented the huge US dollar $444 million in losses that he incurred in the stock. The lesson here is that even a brilliant investor like Warren Buffett does not have a well-defined selling strategy and has committed errors like Tesco. And if you thought Tesco was an exception, here's another one of his fiascos in the form of Dexter shoes. Buffett bought Dexter shoes back in 1993, and to make matters worse, he paid US dollar $433 million by way of acquisition cost in the form of Berkshire Hathaway stock. Put differently, instead of paying cash, he paid by way of Berkshire Hathaway shares worth US dollar $433 million. Around 8 years later, the Oracle of Omaha was left licking his wounds as the competitive advantage that he thought Dexter had vanished. The company had to end shoe production in United States and another overseas location, and what was left was merged into another Berkshire unit. The loss to Buffett was not US dollar $433 million that he paid to acquire Dexter. It was US dollar $3.5 billion, because the Berkshire shares that were worth US dollar $433 million in 1993 were worth US dollar $3.5 billion in 2001. As per Buffett's own admission, Dexter was the worst deal he had made back then. Well, I started this video trying to get some insight into selling. I was looking for a good exit strategy so that I can help investors in stocks like Titagarh Wagons, RVNL and IRCON put together a sound exit plan. But I have drawn a blank, to be honest. The first strategy we discussed was good on paper but raised huge question marks in theory. Then we tried to follow Warren Buffett and realized how even he lacked a coherent exit plan. In fact, we were surprised to know that he had made blunders that you can't expect from a novice investor. He made blunders that you can expect from a novice investor, but not someone of the caliber of Buffett. Therefore, we are back to square one. We are yet to find a proper solution to the burning question that's on the mind of railway stock investors. When exactly should we sell our stocks? Well, I think we made a mistake while trying to look for a sound exit or selling strategy. We perhaps tried to look for complex solutions. We thought that since there are so many factors involved, a selling strategy would be a multiple step process encompassing quite a few data points. However, what we did not consider was that in a field like investing, it is usually the simple thumb rules and back of the envelope calculations that prove to be more effective than complex solutions. Yes, you heard that right. Instead, for looking for a complex selling strategy, how about we select an extremely simple one? And there's one that I'm particularly fond of. The strategy is not only simple, but has known to work across most stocks. Now here's that strategy. Once you buy a stock, you sell it after a 50% to 100% returns or a holding period of 2 years, whichever is earlier. Let me repeat this selling strategy. Once you buy something, you sell it after a 50% to 100% gains or a holding period of 2 years, whatever happens first. You see, for the first few years of my career, I was more about making big money from stocks. I was always on the lookout for the next multi-bagger. However, I did not have the success I expected. Either I was wrong in guessing the strength of the company's competitive advantage, or its management, or even both at times. And on the rare occasions I got both these elements right, I ended up recommending the stocks at expensive valuations. Consequently, big multi-bagger stocks were always elusive. I don't remember I ever succeeded in recommending a big fat multi-bagger to my subscribers. It was a little later that I realized that investing is not just about finding the next big multi-bagger. As a matter of fact, you are likely to achieve more success in going after the most certain money than big money. Let me repeat that. If you have not had success making big money from a handful of stocks, you can try betting on the most certain money. You see, most stocks are cheap at one price and expensive at another. Therefore, all you have to do is buy these stocks when they are available for cheap and sell them when they turn expensive. Put differently, it is similar to buying a stock that you think is worth rupees 100 per share at rupees 60 or lower. When viewed this way, selling becomes quite simple. You buy something at rupees 60 or lower and then sell it when it reaches rupees 100 or slightly higher. As a matter of fact, this is exactly what I do in my recommendation services like Microcap Millionaires and Exponential Profits. I recommend stocks that are trading at a good discount to their book values or are available at a PE multiple of 10x to 12x, and then recommend a sell after they have gone up 50% to 100% from the recommended prices. The close to 80% success rate I have achieved in doing this is proof that this approach does work over the long term. Please note, as I said earlier, my goal is not to make big money. It is not to recommend multi-baggers. Instead, it is to try and help my subscribers make the most certain money which they have made in 80% of the recommendations that I have closed over the past few years. So to come back to the original question of whether you should sell your railway stocks, evaluating the decision from the point of view of making more certain money instead of big money may help. The questions that you need to ask are these stocks still trading at a PE multiple of 10x to 12x or are available below their book values? If the answer is yes, then perhaps one can consider investing in them even at current levels. But if one has already made 50% to 100% returns in them or even higher, then a partial, if not a full exit can certainly be considered. Do understand that my goal is not to earn multi-bagger returns from these stocks. For that, you need to assess the competitive advantages of these stocks in detail, take a call on the quality of the management, and try and estimate their earnings few years down the line. I personally find this method to be complex, and I'm therefore happy with the 50% to 100% returns over 1 to 2 years. I'd rather earn a series of 50% returns across 4 or 5 different stocks than stay invested in a single stock in the hope that it turns into a 10-bagger. I'm not saying that my approach is the right approach. All I'm saying is that it is the one that I am more comfortable with. Likewise, you should also choose the one that suits your temperament better. I hope I was able to make some sense here and bring some method to the madness that exists around selling in the stock market. Do share your views and feedback. I'll see you again next time. Goodbye and happy investing.